Welcome, Chinchilla Pickers. Hey, my name is Brandon Beaver, and you know my co-host is usually David Underwood. He will not be able to make it tonight, unfortunately, but we will see him next week. And so tonight, it is on me, it is on my shoulders, which I'm happy with, to entertain you, uplift you, and inspire you. All right? It's fine. I love doing these things. So let's get on with the show. Let's talk about investing psychology, because what I want you to do is find the right philosophy in investing for yourself. Mine is contrarianism. I'm a natural skeptic. In fact, anytime I find myself agreeing with the collective public, I'm generally asking myself where I went wrong. Because at that point, I know I'm wrong. Everybody else thinks I'm right. So I'm wrong. I have to be, because I don't see... Listen, the collective problem, or the collective public, is generally terribly wrong on just about everything. Not always, but generally. So my favorite thing to do is to pick discarded stocks that have been unnecessarily discarded by the general public, to buy those, wait for the general public to come around to my side, and then once they're buying, I'm selling. That is my investment philosophy in a nutshell. And when Dave got me to invest, he actually convinced me to get into the stock market years and years ago. The first book that he recommended to me was The Warren Buffett Way, which was perfect. Like, it literally wound up being perfect for me, because Warren Buffett is the ultimate contrarian. And he has been so successful at this. Okay? There's that phrase in the market that you should never, ever try to catch a falling knife. Warren's been catching them his entire life and juggling them. By the way, I don't agree with that phrase. I don't agree with the phrase to not catch a falling knife. Because generally by the time the knife's not falling anymore, it's just coming back up and you've already missed the opportunity. The key really is to start buying these stocks that are discarded for bad reasons. If they've been discarded for bad reasons, but that's your job to sift through all of the research, the cash flow statement, the income statement, the balance sheet, all that stuff, you sift through it, you can figure it out. All the information's right at your fingertips. We have so much knowledge available to us now that Buffett didn't have when he started out. Ben Graham didn't have it, one of the greatest investors ever. Yet, we've gotten dumber. Guys, we're not utilizing the knowledge that most people aren't doing it. I mean, it's frustrating to me in a way, but it's a blessing in disguise, and you should see it as a blessing in disguise. Listen, if you are one of the people that's utilizing the knowledge that is given to us every day, then that's great. You're one in a million, right? But the good news is that you're one in a million. That's the good news. And actually, really, for us, it's good news that a lot of other people don't do it, because you take advantage of their mistakes. And you should be doing what the competition's not doing. Now, I will never be the type of person that you can come to and ask my opinion on today's latest hot stock. That's not going to be me. And I'm not insulting people who trade the hot stocks. Dave often does them. He does it with success. It's just not my thing. But me and him work together really well in that way, where he can momentum trade, and it's in his philosophy sometimes to kind of ride off the backs of the hot stocks and the high flyers. For me, I'm always being a contrarian investor. When the media is telling you, hey, when everybody is telling you something is a great buy, to me, it's no longer a great buy. And that leads me to the mistake I made last week, okay? Because nobody's perfect, right? Alibaba was trading around 240 when I said on this podcast that I thought it was a great buy. I still think it's a great buy. My timing was wrong and I made a mistake. And the reason why I made that mistake, if you go back and listen to last week's episode, I said that the media telling you to buy Alibaba, that they were actually right this time. And I still think that. I still think it was a good idea to wait until you found out what the antitrust monopoly regulatory board in China was going to fine Alibaba. Wait until that happened so that you knew that they weren't really going to tank on it, okay? However, buying right after that when the stock had gapped up about 8% was a mistake. What I should have done and what I should have told you to do at that time was to wait it out. And if the stock continued to move higher, great. I mean, it kind of sucks because we missed the opportunity on it, but there's always another opportunity right around the corner. What, in retrospect, was more likely to happen is what did happen, in that a bunch of people took profits at that 240 level and they drove the stock right back down, which is when I should have been telling you to buy it. I shouldn't have been telling you to buy it at 240. I should have told you to buy it at 226. So what did I do? I didn't sell Alibaba because I did like the price at 240, which means I liked it even more at 226. So what I have done, I bought more. If you go back into the Chinchilla Instagram, you can see when I bought more. I told you that I was going to do it, and I was just waiting for the right time, and I did right around 226, 227. And now my cost average is a lot lower than what it used to be, and I'm happy. In fact, I bought a bunch at 226, 227. I trimmed it today at 233. So I now have the same amount of shares that I did back when I first bought it at 240, but now my cost average is a heck of a lot lower, and I was able to make a little bit more money off the small pop that it had today before it came back down again. But Alibaba right now, Alibaba, still a good buy. Now, a lot of people are going to be looking at other stocks that weren't, they're still in the crosshairs of the Chinese Communist Party. And I'm saying the Chinese Communist Party because that's what they call themselves. I'm not using the word communist as an insult or anything like that. It's just what they are. They're the Chinese Communist Party, right? So these big tech companies are in the crosshairs of the CCP. All of them are right now. So in that philosophy, because in my philosophy, the hedge funds have dumped these stocks. Well, I'm here to pick them up. But you have to pick up the right ones, right? So what I did yesterday is I went through 3 of the top Chinese stocks. And I think there are 3 of the top Chinese stocks that are likely to come out on the other end of this better than where they're at today, because they're doing so well. But also, they're not the kind of Luckin coffee, that situation with China where you're going to have to worry about fraud or any of that. These are honest companies, in my opinion. There's nothing that, looking at the balance sheet, the income statement, the cash flow statement, all of that, there's nothing that screams too good to be true. They're good, but they're not too good to be true. And to me, that's good news when it comes out of China. So let's talk about this real quick. So what are we going to do? We're going to buy Alibaba, or we're going to buy Tencent, or we're going to buy JD. Now, I bought Tencent and Alibaba. I left JD out. And the reason why I did it, they've got a very low gross profit margin. Their gross profit margin is 14.62%. Compare it to Tencent's 45.95% and Alibaba's 45.12%. It's meager. Now, looking at their balance sheet, I'm actually in many ways, I was actually really, really surprised. You've got this up and coming and growing phenomenal company. And they're growing at phenomenal rates, but yet they're actually pretty conservatively financed now. A few years ago they weren't. They were losing money, but in the past 2 years they've turned that around. They've become profitable. Their long-term debt is minimal when it compared to their net income. They have no issues with debt whatsoever. But it's that gross profit margin that cancels them out for me. Now, Tencent and Alibaba both have great balance sheets too. There's some things that they could do better on. For example, spending on selling general administrative costs, relatively high. I mean, Alibaba's got 34.29%. Tencent's 43.8%. JD is a very high 74.3% here. And that's another thing that's kind of concerning. But look, if you look at the return on equity, I mean, for JD.com, it's 35.37%. Tencent's 27.24%. And Alibaba is 23%. And traditional valuation methods also, JD.com has better valuations right now. Like according to traditional valuations, JD is probably a better value at the price that it's at right now. Price to book's 4.77%. Price to earnings ratio is 16.66%. Compared to Alibaba's price to book, which is 4.77. It's the same. But price to earnings is 27.82%, so higher. And then price to earnings for Tencent, 33.1%. And price to book 6.43. So actually JD scores better on valuation metrics. It's just that gross profit margin that concerns me, and it kind of canceled them for me. So I bought Tencent and I bought Alibaba. And I'm happy with it, and I'm going to hold them. And I'm going to hold them until the rest of the market comes around. You know, there are risks here. There's always risks when you're investing the way that I'm. There's risks in everything. You're investing in a contrarian philosophy. The fact of the matter is a lot of these stocks did get beat down, and they got beat down for reasons they just got beat down too much. So you do have a risk of what I would call unknown unknowns when it comes to Chinese policy and the crackdown on tech. But in regards to China stocks, I think these are the best deals. I think it's Tencent, Alibaba, and JD. And I pick Alibaba and I pick Alibaba and Tencent. And if you want to be diversified, maybe you should only pick one of these, because you're exposing yourself to the same risk. For every Chinese stock you buy, it's the exact same thing that's gonna, especially the tech Chinese stocks. The risk is with future policy in China and regulatory crackdowns. So maybe only pick one. I picked both, but that's because I really believe in Tencent and Alibaba. But don't sell the Alibaba. Buy more. All right? Buy more. And, if you have it in you to buy Tencent, then do that as well. Because I think they're both great valuations right now. And I do think that the market will come back to them. I have a lot of stocks right now that are on my watch list that I'm just sitting on, waiting and salivating to get into. But, I'm a contrarian, so it's how I am. I'm not going to buy a stock that's been up, 100% for the last year. I'll buy Alibaba that's done hold on. Let me check this real quick just to get it right. 8.49% for the year. And I've honestly had Alibaba on my watch list for a very long time. I wanted to buy it last year. I loved it last year. But guess what? Last year it was trading in the $300 range. And there's no way I would have touched it with a 10-foot pole. I'm not going to buy Microsoft right now either. I wish I could. I'm glad I'm not. It's up 50% for the year. I will gladly sit on my hands and wait for a market pullback to bring Microsoft unnecessarily down with it so that I can get a better deal. I love Microsoft, by the way. I love the Game Pass. I just got MLB The Show 2021. It's a pretty good game. It's bringing back bad memories for me, though. It's bringing back bad memories because I'm a terrible hitter on the game. And I'm a terrible hitter in real life. I once swung at a pitch that I was hit by. Oh man, I have no shame. I have no shame, do I? I just told you, I think earlier in this podcast, I don't know if I said it actually. I'm kind of lost in my head right now. But I noticed in our Anchor Analytics that we have listeners in Switzerland and Australia, and that's really freaking cool, man. My voice is being heard by people all around the world right now. I can actually say that is phenomenal. I love technology. I'm not good at it, but I love it. People in Switzerland now know I once swung at a pitch that I got hit by in real life. I struck out in softball twice, and then my third time up at bat, this was one game, my third time up at bat, I popped out to the pitcher. But, nobody's perfect, okay? It goes back to nobody's perfect. I'm admitting my mistakes. And listen, this is something that I want you to get out of this podcast, out of our website and everything. You don't only learn from my base hits and doubles and home runs and all of that good stuff in stocks, of course, but you learn from my mistakes as well. That's a power that we can give to you. That's something that is so powerful about this, I think, that you can learn from the things that I did wrong, because I'll tell you when I did them wrong. And the fact of the matter is, we've gotten so much right on this program, and I don't want to pat myself on the back too much, and I don't want, I will pat Dave on the back a lot. Sometimes he needs the support. But anyways, we've gotten a lot right. I mean, we got Apple right. We got Facebook right. We got so many things right on this program. We get one thing wrong, we get a pass. And I don't think that we got it wrong for the long term. I just think I got the timing on it wrong. And I explained to you why I did it, and we'll move on from there, right? I'm not dogmatic either. I mean, I'm willing to change my mind on some things. And the cryptocurrency market got too hot for me. So last week, right, we were talking about this, the Coinbase IPO. And at the time, Doji was going crazy. Bitcoin was up. It's still up a lot for the year. But since then, Bitcoin has come down about 12%. Well, I'm sorry, I'm looking at it now because we just had another drop about an hour ago. So it's been down now 19.09% is where we're at. And it's still going down at this moment in time. And I thought to myself last week, I really do think that inflation can be an issue. And I do think that it will creep back up, right? But crypto was too hot. Bond yields suck. I'm not touching those. The fact that inflation on a yearly basis right now is higher than what the 10-year will give you is just terrible. So I'm not touching bonds. I wasn't touching crypto. I'm still not touching it right now, even with it being down the way that it is in Bitcoin. It's starting to get a little bit more attractive to me, but it's 620% for the year. That's insane. So my decision actually was to buy gold in the form of GLD, the exchange traded fund. And I bought it on Friday of last week. Now the 52-week high on this is 194.45. It was reached back in August of last year. Now, back in August of last year, the reason why that happened, we were dealing with new stimulus plans, and so we knew a bunch of money was about to flood the market, right? We're still in that position. So we've gotten 3 stimulus checks, right? And we're still in the position that money is about to flood the market because a lot of this stuff got tied up in either stocks or it's still sitting in savings accounts. Reopening is happening right now. On a faster and faster basis, it seems like every day we start to reopen. And as we reopen, that money is going to get spent. And as it gets spent, the value of the dollar is going to come down. You're going to see an increase in the CPI. So my solution was to buy GLD. I bought it Friday and I'm still holding it. And I still have Nuance. This is kind of what I'm treating like my bond. So we know that Microsoft is going to buy Nuance for $56 a share. At least if the deal goes through. And it seems like there's not much of anything that's going to stop it. Currently, we're sitting at $53.10. And every time this thing drops below $53, I buy more shares of it. At some point, I'll stop once I feel like I'm over-invested in it. Right now, I really don't feel like I'm over-invested in it. So I'll continue to buy it every time it drops below 53, as long as it's not doing so on some news that Nuance shareholders might not approve the acquisition. This is so crazy to me. Look, at Nuance, all right, at one point, the short float on this was at about 73%. So that means that the amount of shares out on the market, 73% of those were short Nuance. It fell all the way down to 30% right before this deal was announced. So you could see, I mean, clearly there's insider trading. People knew that Nuance was being bought by Microsoft. Or at least that it was about to get bought by somebody. There's no way you have a 73% short float drop all the way to 30% without people being in on the deal and knowing that it's going to happen. So guys, if you think insider trading doesn't exist, I don't know who thinks that. But if there's somebody out there that thinks that, then I just have to tell you it does. And people get away with it all the time. It really sucks. This is why you just have to hold steady with your investment philosophies and be really, really prudent about what you're doing. Because you're up against a lot of people that know a lot more than you do. But you can still do it, right? You can still find a good investment philosophy that works for you and stick to it, and you can take advantage of all kinds of market inaccuracies and inefficiencies. But in regards to Nuance, I mean, it's still like you're not going to get many chances in the market where you have something as for sure as this is. So even if it's only 5 to 6% that you're going to make by the end of the year when this deal goes through, I think you should still take it. I still think that you should be adding to Nuance every time it drops below $53 and into $52 a share. Especially in this market. I don't want to scare anybody, but I don't have a crystal ball in front of me, but there's some warning signs that I see in this market. I've been doing some research and going back into the .com bubble and the causes of that and the signs of it as well. And I think it's particularly relevant to today because here we are talking about the reopening and how a lot of people think the economy is going to take off. We're poised for incredible economic growth. But it seems to me like that's already priced in. And the S&P 500 seems in particular to be overheated. And I want to remind people Listen, when you go back and you look at the dot-com crash, there was no preceding economic event that led to it. It just happened. People just realized that stocks were overvalued, and they sold them. And then it triggered panic selling. And the bubble burst. One of the signs that this was going to happen was the buy the dip mentality was crazy, okay? Mutual funds that used to hold stocks for 2 years or more were on average at the end of the 1990s holding stocks for 10 months. And that's average. So a lot of these people went from one extreme to the other, holding stocks for a very long time and holding them for months, even weeks sometimes, okay? And I kind of see a similar pattern to that with me. Because a few years ago, I was buying and holding for a very long time. Now, most of the time, I'm months, if that. And the reason this happens is because mutual funds were starting to see gains in a very short amount of time that used to take years, and they would get these gains in months. And as I said, I was taking a year to make a lot of the gains that now I'm taking sometimes 3 weeks. I got 15% out of Facebook in 3 weeks after the NASDAQ drop. And the NASDAQ drop, it went into correction mode. It didn't stay there for very long. It was like 2 weeks and it was right back out of it. So I don't want to scare you. Nobody should trade scared. You're not going to make any money doing that. It's not a good idea. But you definitely should trade with your mind about you and knowing and seeing these signs and taking your gains when you can get them. And when a stock becomes fairly valued or overvalued after you've bought it undervalued, you sell it, you make your money, okay? And always have cash on the side so that when the next bubble bursts, you are ready with that money to take advantage of the great deals that will be ready for you to scoop up. And that is how you buy and sell as a contrarian in 30 minutes. I think I did an alright job tonight. I hope you think the same thing. But I will see you next week, and Dave will be back again. So, have a great week.